Is the Federal Reserve Chair the most powerful person in finance?
Yes, and arguably maybe the most powerful person in the free world.
There you go. Will, is the chairman of the Fed the most powerful person in finance?
I think so. It's really difficult to think of someone who's more powerful than the chair of the Fed. So, yeah, I'm going to go with a yes.
All right. Well, that's our podcast today. Is we're going to be talking about the most powerful position in finance in the world. Well, welcome back to the Economist Next Door. I'm joined today by Lydia, who is actually part of a conversation I had with Pete Earle last week about financial markets, financial crises, and inflation. So Lydia Newman is the director of our monetary policy team at the American Institute for Economic Research. And we're also joined by Will Luther, who's an associate professor of economics at Florida Atlantic Coast University, or Florida Atlantic University. I always say coast. I want to think Gulf Coast. Florida Atlantic University.
We're on the other coast.
Yeah, exactly, the wrong coast. He also directs AIER's Sound Money Project, and so he writes about the Fed extensively, follows it closely, and these are the perfect people to have on to discuss the prospects and implication of getting a new chair of the Federal Reserve, Kevin Warsh. Kevin Warsh had a hearing recently before the Senate talking about Fed independence, how he would run the Fed. There's a lot to discuss there, but just to kind of frame it up for listeners who maybe don't read the Wall Street Journal every day, maybe don't know a lot about either the process of becoming the chair of the Fed or even what that means, let's talk a little bit about the Fed. We'll talk today about how the Fed should operate and in particular, looking at the influence that Fed chairs have, the chair of the Federal Open Market Committee, which is sort of the governing body and decision-making body of the Federal Reserve. Federal Reserve chairs historically can have a big impact on the shape of the Fed. And for those of us who study the Fed, all of these chairmen I'm about to list are associated with different kind of eras and approaches of the Federal Reserve. When you think about Arthur Burns ushering inflation in the 70s, we can think about Paul Volcker, who was sort of famously tasked with and fairly successfully ended that inflation, the stagflation. Alan Greenspan, the longest serving chair of the Fed. Some people called him the maestro, right? The great moderation. He ended maybe not on quite a high note, or at least right after he left. Because then you have Ben Bernanke and the 2008 financial crisis and all kinds of things going on there, where he's sort of managing maybe a little bit of the decline and mission drift that happened at the Fed. Janet Yellen was chairwoman for a year, maybe, not very long. So I don't have much to say other than it was a short-lived tenure. But then we have Jerome Powell, Jay Powell, who's been the current Fed chair, who's been, getting in fights with Trump, or maybe Trump's been getting in fights with him. He's been chair during COVID and then also during the recent bout of inflation. And so now the question is, if Kevin Warsh becomes the next chair, what will that mean for the Federal Reserve? Will he be associated with perhaps the idea of reform? Right? Will he be a reforming Fed chair? So to start us off, Lydia, why don't you kick us off here? Maybe tell us a little bit, what do we know about Kevin Warsh? Who is he? Why has he been appointed or nominated to be chair of the Federal Reserve?
Great place to start. So Kevin Warsh has sort of your typical Washington power broker connections. He went to Stanford for his BA, got a law degree from Harvard, has been under the tutelage of Stanley Druckenmiller, who also was mentor to the current Secretary of the Treasury. And he got his sea legs a little bit on Wall Street, doing mostly mergers and acquisitions. But since then, he's kind of been in this in between academic and politico, basically since the early 2000s. He went and served in the Bush White House, was a economic advisor and liaised with the NEC, the National Economic Council, but also with Treasury. And then by 2006, I believe, he was then appointed to be a board member at the ripe old age of, I think, about 35 or 36, to serve on the board of governors of the Federal Reserve System in Washington, D.C. So that was, I think he may have been the youngest member to be appointed. And so he was there during the financial crisis and was there helping with some of the work to bail out some of the institutions, but became critical later of the Fed's balance sheet and how long the Fed was continuing its emergency policies, and eventually left the Fed before his tenure concluded. And since then, he's been working in the private sector and making bank, I'm sure. That was a question of his testimony before his nomination hearing the other day, but has also been heavily involved in the Hoover Institution at Stanford and has continued to comment on issues related to the Fed and is somewhat largely viewed as a inflation hawk generally, aside from recent pronouncements in maybe securing his nomination from Trump. But also he seems to have quite an affinity for some work by Milton Friedman, and he had some really interesting things to say both during his nomination hearing and previously about both the Fed's balance sheet and the importance of price stability as the Fed's remit. So we'll get more into that, I'm sure, but that's in a nutshell. A couple of other random factoids, and then I'll stop soapboxing here, but I do find it fascinating. He happens to have the good fortune of being the husband of Jane Lauder of the Estee Lauder family of cosmetics brands, and so he is very well connected in the New York Wall Street and New York families of ages past, even though he himself comes from middle income beginnings in upstate New York. So I always find those factoids fascinating.
Absolutely. Well, it's a great overview and background on Warsh. I mean, the takeaway here is he's like an all-star. I mean, it makes me feel like, he was board of governors at 35. It's like, what am I doing with my life? It's sort of like I'm not necessarily haven't arrived yet. But very impressive academically, financially. He's very connected. So great bio here. Will, can you talk a little bit maybe about what we know of his views on monetary policy, on the role of the Federal Reserve? Lydia mentioned he's historically been a bit of an inflation hawk, meaning he's been very concerned about inflation, leaning more towards raising interest rates sooner or not lowering rates. What would you say? How would you describe kind of just at a very high level his approach to economics, what we know about how he's been talking about what the Fed should be doing and maybe some reforms of the Fed?
Yeah, I would say traditionally he's very much been a hawkish central banker, very much opposed to high inflation, very quick to change policy if he is concerned about high inflation. So very hawkish in that regard. The other thing that I would say is that more so than most other central bankers, he has an apprehension about this large balance sheet that the Fed has been carrying. He wants to shrink that balance sheet. Now, it's not clear how far he wants to go. Without getting into the weeds too much, the Fed has an ample reserves regime, or sometimes this is called a floor system. And it's not clear that he wants to shrink the balance sheet so far that would return to a corridor system. But certainly he wants to shrink the balance sheet. He's been pretty clear about that. And then the third thing that I would say is that he has at least a slightly different view on central bank independence than most central bankers have in a couple respects. First, thinks of this central bank independence, or at least seems to think of this central bank independence as relating exclusively to the Fed's monetary policy function. If you go back to the Constitution, Congress is in charge with regulating the value of money. It's delegated that to the Fed, and so certainly on constitutional grounds, the central bank's monetary policy should be insulated from the executive branch. But for he's been relatively clear that when it comes to those executive functions, like regulating banks, that is an executive authority, and that the central bank should not be independent from the executive on those issues. So that's not something that you hear from most other central bankers. Central bankers, like all of us, we like to protect our own domain, right? And give ourselves as much leeway and as little accountability as possible. But he has taken a different track. The last thing I'll say about his slightly different views on central bank independence is that more so than any other central banker, he has acknowledged the risk of central bank independence. So usually we stress the benefits. It prevents the fiscal authority from engineering inflations, perhaps to improve their election odds. But the risk is that the central bank will use these arguments to insulate themselves from legitimate criticism. And so Warsh has said that the Fed in particular has used this central bank independence argument as a bit of a shield, but also as a sword to kind of carve out new territories for itself. So again, that's not something you hear from a lot of central bankers, but it is something that you'll hear from Warsh.
Yeah, and he's aware of this, the debate right now between independence and accountability. We'll definitely be coming back to that, trying to think through why do both of those things matter when it comes to monetary policy. You want the independence, but you also want accountability. But I want to talk about the Fed's balance sheet for just a minute. So for listeners who don't know, the Federal Reserve, a huge part of how it operates within the financial system is it buys and sells assets, mostly buys, but can also sell. And it does so for a variety of reasons to provide liquidity or cash in times of crisis. It uses it to affect certain kinds of interest rate targets that it pursues. And post the 2008 financial crisis, the Fed has engaged on a very steady, very significant growth in its balance sheet from under $1 trillion going into the 2008 financial crisis to reaching a peak a couple years ago at about $9 trillion. So $9 trillion of assets that the Fed held. Now, when they began raising interest rates and trying to combat the recent bout of inflation, they began rolling those assets off. Right now, the balance sheet's a little bit below $7 trillion, but that's still 7 times the size pre-2008. And Will, as you were saying, Kevin, you don't hear this a whole lot, and like the current board has sort of like stopped reducing the size of the balance sheet, right? They've actually sort of stopped rolling it off and even increased it a little bit. So he's pretty unusual, it seems like, in terms of saying this is an issue, we want to shrink the balance sheet more. And then to the point you were making, it's unclear, do you want to shrink back to like pre-crisis levels where when you don't have a big balance sheet, the Federal Reserve moves interest rates by buying and selling treasury bonds or bills to kind of move the interest rate through that. Under the ample reserves regime or the floor system that Will was talking about, the Federal Reserve has put so many reserves into the system that the interest rate would be zero unless they paid interest on reserves to banks or they paid various swaps. And so they've liked having a lot more control potentially over that. So that's just like little nuts and bolts mechanics of the balance sheet, and you guys can weigh in if I'm missing anything on there. But Lydia, I want to come to you with something that I actually found really interesting in Warsh's nomination or confirmation hearing. It seemed to me he was suggesting that the Federal Reserve should stop its forward guidance. Right. So one of the things the Federal Reserve does is not just make a decision at a moment in time about interest rates, but they have these projections, affectionately called the dot plots, right? Where you have these dots where the different Fed officials say where they think interest rates will be or should be 3 months, 6 months, 12 months out. And Warsh said that might not be the best way to run things. Do you want to comment on that? Am I reading that correctly in terms of him kind of suggesting maybe moving away from that?
You're correct. He's been critical of forward guidance, which is a policy tool as named that really came out of the financial crisis. And what is meant by forward guidance is essentially not just the dot plot where Fed officials are releasing their projections about where the economy is headed under optimal monetary policy. It is basically any communications that the Fed is doing. And so I used to joke that forward guidance is a bit of just a confidence game. It is the Fed going out there and making pronouncements about where they think the economy is going, because so much of monetary policy is contingent upon expectations in the marketplace. And so the Fed found that this was actually one of their most important tools in the financial crisis in particular, by signaling to the marketplace what actions they would or would not take. Arguably, that kind of blew up in their face a little bit when they signaled to the market they would bail out people like companies like Bear Stearns, and then they decided not to bail out folks like Lehman, but that was the topic of our last podcast. But that forward guidance is something Kevin Warsh has been somewhat critical of. It actually arguably boxed the Fed in the inflation run-up post-COVID. They had signaled that there would be a long amount of time, or the markets would be well prepared before there was any change in the stance of monetary policy. And this is something Governor Chris Waller, who had been a contender for the nomination for chair as well, has also mentioned that level of using your communication tools to communicate your policy can also have adverse consequences by tying your hands. So what you say has consequences, and then if you renege on what you say, that also has consequences. And so Kevin Warsh, I think, favors something that's a little bit less subjective. I'm not sure I can say that he's a full, let's move to a full rules-based monetary policy, but he's certainly skeptical of the role forward guidance has played, and wants to look at that, and that's on his, quote, reform agenda, which he had mentioned during his confirmation hearing.
Yeah. So Will, on this...
Maybe I'll say
ahead.
a little bit more about this, because on the one hand, expectations are very important in any macroeconomic model. Expectations are going to be very important. So the idea that, the Fed shouldn't try to shape expectations, it's like, well, it's going to. And the question really is just, how is it going to? And, I think that for Warsh, the concern, as Lydia was saying, is really that it can box itself in. If you go back to December of 2021 and just look at what Fed officials were saying, right? They had already acknowledged that there was a demand side inflation problem and that they were going to start raising interest rates beginning in March. But as the data came in the months that followed, in January and February and March, that data consistently revealed that they had underestimated the extent of the inflation problem. In fact, in December of 2021, they made a projection for inflation for 2021. Now they have 10 months worth of data there, right? They lived through November and half of December. And so the amount of unknown in that annual inflation rate is pretty small. And yet they would learn in January that actual inflation in 2021 was greater than the highest estimate from any of the FOMC members in the prior month. So they were just really wrong about how high inflation was. And the data in February similarly revealed that they had underestimated the problem. And the data in March similarly revealed that they had underestimated the problem. And so you might think that having gotten all of that information from December to March, particularly since at every press conference, Chair Powell says we're data dependent, you might think that they would say, hold on, we had misread the situation. And so now we're really going to have to ratchet up interest rates. Instead of the 25 basis points that we projected, we're going to do 50 or 75 basis points. We're going to follow this up in May with another 50 or 75 basis points. But the thing is that the Fed did not do that. Instead, they just followed the course that they had projected back in December. And so I think that is the real concern with forward guidance, that once you say you're going to do something and you anchor expectations on that, it just makes it so much harder, at least given the views of most Fed officials, to do anything else. Where, I think Warsh has more of the view that if we've got an inflation problem, it doesn't matter what we've said. We've got to take care of that problem. And we got to take care of it quickly before it gets out of...
Yeah, there's a lot of interesting things in what you said there. So I like that point about not doing forward guidance the way they've done it. Doesn't mean not communicating, right, about what they're going to try to do. It's more about maybe not pre-committing to targets that they're unwilling to change in the future. But I think that leads to a challenge too, because on the other hand, that suggests in a way that they want more discretion, does it not? More discretion to fight inflation sounds good, but more discretion in general is maybe a bit of concern when it comes to the Feds. Do you think there's a way to kind of square that kind of concern of communicating, not overly committing, so you're more flexible, which would have been helpful in our last round of inflation to adapt much more quickly and admit error. But then there's also this concern of, well, maybe there's too much flexibility or discretion in terms of making decisions.
Yeah, I think if you're giving forward guidance about your objectives rather than your means to achieve those objectives, that's probably a good way to go. So for example, if the Fed said, next year nominal spending is going to be 5% higher than it was this year, that allows people to, that anchors expectations. Or if they were to say, next year inflation is going to be 2.2% higher than the price level is going to be 2.2% higher than it was this year, right? Again, that anchors expectations. But what's the interest rate going to be? Well, it's going to be whatever those Fed officials think that it needs to be to deliver on that objective. And so there, you're providing forward guidance. You're allowing people to set their expectations, which they need to do. They've got to figure out how those broad macro variables are likely to evolve in order to enter into long-term contracts, to figure out their production decisions. Right? They need to form expectations over their production horizon. But when you're telling them what the means are going to be, that you're going to set this particular interest rate at a particular level for so long, well, what if the data reveal that that's not the right place to put it, right? That it's actually inconsistent with your objective. Well, now you've told them two different things, right? You've said that you're going to pursue this particular means to achieve this particular ends, and when those means and ends are incompatible, what are you going to do? You're going to let them down in one way or another. So, I think if Fed officials were more focused on providing forward guidance about their objectives as opposed to their means, that's probably a better way to go.
And we have a good example of that going back to some of the chairmen you were mentioning, but this is what Volcker did when he came in with very high inflation. He committed to, we're going to be bringing inflation down. He said he'd be looking at monetary aggregates and wanted to see those come down. And the markets expected him to do that. It was painful, but he committed to that objective as opposed to committing to a specific instrument in between getting to that objective. And it instilled some confidence, though there was still pain, but that was arguably from past mistakes by earlier Fed folks.
Right. Well, it's interesting listening into the hearings. Hearings are kind of odd things. We were talking about this before we recorded here. Like the congressional hearings are just weird, but
political theater.
Exactly. And so Warsh was being very more guarded probably than normal. But I found it interesting, and it goes to this idea of guidance, where one of the more reasonable questions that one of the senators asked him was, well, generally, when you lower interest rates, that tends to boost the economy. And when you raise interest rates, that tends to slow it down. Given where interest rates are now, if we move to like 1% short-term target interest rate, like a massive drop in the short-term interest rate by the end of the year, would that be inflationary? And the answer to that is like clearly yes. But Warsh wasn't willing to he didn't want to get pinned down. He was just sort of like, again, kind of focusing on the goal. But that was like a fairly easy, in my view, I think a fairly easy answer. Going from where we are now to like 1% by the end of this calendar year would have, I think, dramatic effects on certainly the stock market and probably the economy more generally. But he was very cautious about not answering
I'll
that.
I'll make the Warsh defense here.
All right.
When we're thinking about interest rates, we're talking about nominal interest rates. And the nominal interest rate is the real rate plus expected inflation. So certainly you can imagine a situation where we get a big contraction in aggregate demand that causes expected inflation to fall a lot, in which case you may need to deliver 1% interest rate because that's what's consistent with neutral. Now, what are the odds, right? Okay, I think we both agree that the odds of that happening in the next 8 months are pretty slim, but not zero. And if you're sitting there in front of the Senate, the Senate Banking Committee, and that they're taking notes on everything that you say, and they're going to bring this up in your Humphrey Hawkins hearing not too long from now, you want to be very careful about the promises you make. You got to think about those low probability events because you might find yourself in one of those low probability events and you don't want to have pre-committed to not do what needs to be done in that situation.
In other words, Kevin Warsh is already practicing his form of forward guidance.
Yeah, I think so. I mean, you see it playing out here of not committing to a policy instrument target. So I guess, there's a lot of directions we could go with this. I suppose one question I have, and this is maybe a little bit more insider baseball, but hopefully will be helpful for listeners. So the chair, if he's appointed chair, he'll be a governor. So you have the board of governors, 7 governors who are appointed by the president with staggered terms. And then you have 12 or 13 district banks? I always get this wrong. 12 district banks, right? 12 district banks. And 5 of those district banks are voting members at any given time. So you have the Federal Open Market Committee, the FOMC, which is the 7 governors and the whichever 5 bank presidents are voting. So 12 members of the FOMC, they're the voting members who basically make most of the substantive decisions when it comes to monetary policy and even some of the regulatory stuff. So Warsh has been nominated to be the chair. I'm curious what you guys think based on kind of the current makeup of the FOMC. Do you think that he'll find a lot of ready allies for some of the things he wants to do? Do you think he's going to have to do a lot of persuasion to maybe really shift the direction and the focus of the FOMC from how it's been doing business over the last several years? What's your sense, at a high level of how much of an impact he's going to be able to have if he's confirmed on the FOMC and kind of implementing some of the things he wants to do?
So I'll let Lydia take your question in a moment, but first let's be very clear about what he's been appointed to do. He's been nominated, I should say nominated, not appointed. Hasn't been confirmed yet, but he's been nominated to be chair of the Board of Governors. Now, by convention, the chair of the Board of Governors is also chair of the Federal Open Market Committee. But that's not necessarily the case, right? The Federal Open Market Committee each year votes on who will be the chair of the FOMC. So there is a very unlikely but possible scenario that he becomes chair of the Fed board, but not chair of the FOMC. That would be very unusual. It would signal massive disagreements on the Fed, would probably cause some confidence issues in markets, but it is also, potentially relevant to your question where you're asking about how much control is he going to have. There's an extreme scenario where he's not even the chair of the FOMC. I don't think that that's likely, but we should first get a sense of the range of possible outcomes before we kind of narrow down on what's more likely.
And I would agree with Will on that point. They could that's probably at the very tail end of probability, but it is quite possible because that is how it's structured. But I do think Warsh, one of his main tasks going in is going to be about building rapport and camaraderie with his colleagues. And I don't think he's not going to come in like a bull in a china shop and be like, this is my way, and strong arm his opinion about where rates should be, or sort of making pronouncements about where the FOMC needs to end up. That's not typically Warsh's style. But he does have strong opinions and strong convictions, and he is going to want to bring those to bear. I think you're going to have a much more robust dialogue between the members. He even mentioned this in some of his confirmation hearing, where he said that a good discussion is actually good for the institution, as opposed to for basically since the financial crisis, the whole goal has been about building consensus. I like to remind people another way of looking at consensus is groupthink, and groupthink is not always beneficial. In fact, I would say groupthink itself is never beneficial. Consensus can be beneficial. But I think he's probably going to go in and try to build those relationships, but using reasoned arguments for why he has the positions that he has. And he's been very vocal that he does think that the Fed needs a reform agenda. This is rather unusual among Fed chairs. You don't usually go in, and even nominees in general, you don't usually go in saying how you want to drastically change an institution. But he has not been shy about being critical of the Fed's mission creep, but especially into things like ESG and DEI areas where the Fed does not have expertise to be able, and monetary policy is a poorly suited tool for handling those issues. And so I do think you're going to see probably some shakeups in the board itself in terms of how the board in DC runs things. Warsh was tasked with being sort of the administrative person when he served last time. He was like point person for looking at administrative issues within the Fed. And so I think he's going to take those jobs very seriously. But at the end of the day, I think his goal will probably be to build consensus through dialogue and conversation and bring the evidence to bear looking at the data. But I think he's also going to bring some theory to the table that's maybe a little different than some of the existing members. So I actually think he might create some allies through that tactic. But getting to 1% interest rates, unless barring one of those far reaching outcomes that Will was mentioning, I don't even know if he's going to try to get members there. And so it'll be a tough order, but I think this is one of the reasons why people say he's sort of uniquely positioned for this time in the Fed, where he can have a reasoned argument for how he could get to Trump's 1% interest rates while also being able to say, hey, I am looking at the theory and the data, and I have convictions about what the economy may need, and I will bring those to bear, and we will try to move forward. So time will tell.
Yeah.
We can think about the composition as well. That might give us some insight here. So, if you look at the regional reserve bank presidents, there's a fairly healthy division in terms of policy views there. Now, they're more in line with board positions than they were in the past. You're getting a lot less dissent from those regional reserve bank presidents. But by and large, you'll get so the New York Fed president is always on the FOMC. So you get 4 regional reserve bank presidents rolling off and rolling on each year. And typically what you see is that you lose 2 hawks and 2 doves and gain 2 hawks and 2 doves, or sometimes it's 3-1 or 1-3, but it's a pretty even mix, by and large. So we can focus on the board, right? The 7 members of the board. And right now, of those 7 members, 3 of them were appointed by President Trump, right? Governor Waller, Governor Bowman, Governor Myron. Now, Myron's kind of in a weird position because his term actually ended in January, but he hasn't been replaced yet. It's possible that Warsh will take that seat. The other possibility is that if Chair Powell steps down, then that will create a fourth opening for the president, and maybe Myron would fill that seat. I think that he seems to be very well respected among Fed economists and has done some good work there so far. So it doesn't seem crazy to me to think that he might be appointed for a full term as opposed to just filling the balance of time that was left on Kukler's seat. But that would give the president 4 of 7 governors. If Powell doesn't step down, if he stays on as governor, then Warsh has 2 other allies and 4 who are perhaps less inclined to pursue the president's policy agenda. So that's the big question, I guess, is whether or not Chair Powell is going to step down. Chair Powell has said he would like to leave, but only if the criminal investigations related to his testimony and the ongoing renovations of the Fed's offices. Only if that criminal investigation gets, resolved. He said he's not going to leave the Fed until then. Likewise, Senator Tillis has said he's not going to vote for one of the president's nominees until this criminal investigation gets resolved. So if that's correct, then as a condition of Warsh making it that criminal investigation has to get resolved, in which case Powell is going to be inclined to leave, and the president will get 4 seats on the Board of Governors. Now, the president doesn't seem too keen to wrap up this investigation. He's kind of doubled down on all of this. I think it was just last week there were some lawyers from the DOJ who stopped by the construction site to look around. They were in an interview. The president basically said, the American people have a right to know how their money is being spent. So he's certainly signaling that he's not going to wrap up this investigation. Now, maybe that's all bluster. Maybe he's trying to, have a stronger negotiating position. I don't know. But that's what's at the heart of all of this, right? Is what happens with this criminal investigation? How quickly will Warsh be appointed? And when will Powell step down? Will he step down when Warsh takes over his chair, or will he ride out some portion of his remaining governor seat? A lot of unknowns there.
Well, and you left out one big one, which is we have a case before the Supreme Court about Lisa Cook and whether Trump can remove her for alleged mortgage issues. And so we're waiting to hear on that too.
You're right. So he could get 5 seats. He could get 5 seats.
Yeah, if he can get over the criminal investigation. We'll see. So this is...
Well, if the Cook thing goes in his favor, if the Cook thing goes in the president's favor, then he doesn't have to wrap up the investigation, because presumably a criminal investigation would also be calls. So he would have calls to fire Chair Powell as well. So, the Supreme Court has kind of signaled that they're not going to let the president fire Lisa Cook. Now, that's unresolved, and who knows how it will play out. But if the court were to rule in Trump's favor, then that would also seem to enable him to fire Chair Powell as well.
Right. Lots of drama. We talked about political theater earlier. Lots of political theater, which is kind of funny. The Federal Reserve normally you don't have a lot of political theory. It's usually very kind of vanilla, except when there's a crisis. But we've got political theater going on here.
I want to make the Fed boring again.
There you go. Exactly. You should give Warsh that sign. You can kind of hold it up and make it boring again. Zooming out here again. Let's talk a little bit about what kind of impact. Again, there's a lot of unknowns, of course, but Warsh has some ideas for reform. He's very concerned about inflation still. He said, inflation numbers are kind of trending in the right direction, but they're still not below that 2% target. What, on a practical level, I know this is sort of very uncertain, but what does all of this have to do with affordability issues, about economic growth issues? We can maybe talk about AI. So Warsh has talked about AI very publicly is bringing really multiple kinds of shocks, potentially a large employment shock, as well as perhaps like a deflationary shock where it increases productivity and actually pushes the price level down some because of growth and productivity. So let's kind of zoom out and maybe try to situate where you think we're at kind of in the economy with inflation, where the Fed's at, and kind of why reform is maybe necessary. So I'm kind of opening the door here to think more about like the economy and Fed policy. And again, you can bring Warsh in or not as you see fit, but there's some much broader kind of questions and issues at play here in terms of where the economy's at, where it's heading, and what that means for future monetary policy.
Well, I think Warsh is right to remain concerned about inflation. If you look at the data and look at what Fed officials have been saying over the last few months, there's a bit of a disconnect. Powell's view is basically, and this gets repeated by other people on the Fed, on the Federal Open Market Committee. Powell's view is basically that the economy has been hit by a series of shocks. And the shocks that he points to over the last year and a half, say, are the announcement of tariffs and then more recently this conflict in the Middle East. And, on their own, we would expect the announcement of tariffs to temporarily cause prices to rise. And we would expect the conflict in the Middle East, it's disrupting oil markets in particular and everything else indirectly. We would expect that to push prices up. So certainly directionally, that seems reasonable. But then the question is one of magnitudes. And what Fed officials don't appear to be recognizing, and in fact, in the, I think it was the January press conference, Powell actually ruled this out, is the increase in spending that we've seen. Nominal spending in 2025 was much faster than Fed officials were implicitly projecting. That suggests we have some demand side inflation. So we're kind of in this weird position where the supply side inflation that Powell is talking about appears to be relatively small, because real GDP growth was very strong. And you get supply side inflation when real GDP growth is lower than you expect, at least prior to the conflict in the Middle East. And yet at the same time, the demand side inflation that we're realizing is greater than Fed officials, most notably Powell, have indicated. So, I think Warsh is right to be concerned about inflation. There are these longer term trends like AI, which may push prices down. But certainly at the moment, we appear to have not totally eradicated the spending problem. We have surging nominal spending, and the Fed has to figure out how big that is, how long lasting it is, and what they should do to bring that down to more normal levels consistent with their 2% inflation target.
And I would just add, I think Warsh it was interesting to see him mention this in his confirmation hearing, that part of the affordability issue is itself, that we're dealing with today, is itself a consequence of poor Fed policy actions, especially post-COVID, maybe some even during, at least maybe through 2021. And that, I think, deserves a lot more attention. And I'm glad Warsh is highlighting this, although the senators didn't seem to quite fully understand what he was saying there, I think, about how government may have been involved in some of this unaffordability that we're dealing with, especially in healthcare and education in particular. But that's a separate point about government spending. But his comments that, look, you've got to be really careful about monetary policy decision-making early on, because you deal with these consequences many years into the future. And so that excess spending, in my book, I think is still partially driven by the overhangs from the amount of stimulus put into the economy, not just by the Fed, but 3 rounds of fiscal stimulus. And those monies are still sitting on the balances, especially of the more affluent in the economy, the ones who have seen the stock market go up. And so I have some affinity for people who are concerned about this K-shaped economy, but I think it's important we remember that what's the original sin in that K-shaped economy. And I think part of that comes from Fed actions, especially in monetizing massive amounts of government debt, that funneled itself into the financial markets first, and then the rest of us dealt with higher housing prices and higher grocery prices, higher gas prices, even aside from the conflict in Iran. So I think having somebody on the Fed who understands that there are long-term consequences of poor policy decisions and has a laser focus on inflation is really valuable. I think one other point, not to go on too long here, is, and people commented on this, he didn't really talk a whole lot about the other side of the Fed's mandate, the employment side. And I think it's important to highlight that if you get the inflation part of the Fed's mandate correct, most economists agree the employment side comes right along with it. You get your best chances at full employment or maximum employment when you give stable, steady prices that are in line with the needs of the economy for businesses and individuals to make decisions. And so I don't think it's a detraction that he has this laser focus on inflation, because it does cause serious dislocations and very long-term consequences for everybody in the economy. So I think that's just something that got a little lost in some of the hearing follow-up, but is an important point.
Yeah, Warsh in the hearing, he quoted Milton Friedman, who famously said and sort of talked about in monetary issues that, the effects of monetary policy are long and variable lags, right? It could be 6 months, could be a year, could be 18 months. And I think, part of I think what the Fed has maybe gotten caught up over the years, I'm curious if you think this or not, is that markets do tend to react to announcements and new information, which you would expect. And so I think there's this feeling of, the Fed can actually impact a lot of things very, very quickly, just making a decision or forward guidance. But in terms of like the real economy, right, money actually being spent and loans being made and all of the economic activity that goes on, that actually takes generally much longer to be affected by various Fed policies and decisions. And so I think you're right. We may very well be living in that world. I wonder how much of that, again, has to do with the balance sheet, where it's come down from 9 trillion, still very high. It seems like shrinking the balance sheet might be a way to pull some of that liquidity out of the market, but maybe there's other things the Fed could do.
I would say on the balance sheet, we often talk a lot about the size of the Fed's balance sheet, but we should think about the composition as well. There is a sense in which, and Governor Waller has said a lot about this. There's a sense in which the size of the Fed's balance sheet is not that important if what the Fed is holding is treasuries. Because what it's doing in that case, if from a consolidated balance sheet view, right, the treasury issues, it has to pay interest on that debt. If that debt is held by the public, it pays that interest to the public. If that debt is held by the Fed, it pays that interest to the Fed, but the Fed's paying interest on reserves. So the Fed is just turning around and then remitting that interest to the financial institutions that are holding reserves. And so that looks a lot like a pass-through, right? Now, it's not a perfect pass-through, among other things, and we've seen this recently. It means that the Fed is bearing the inflation risk there instead of the public. So we saw the Fed take some big losses there on that. It also distorts the maturity duration, the average maturity duration, because the Fed is buying, if it's buying 90-day treasuries and then paying interest on reserves, it's essentially converting those 90-day treasuries into overnight loans. If they're longer-term treasuries, then all the more so. So it's, I don't want to overstate this. But there is a sense in which that this is just a pass-through, and that part of the size of the Fed's balance sheet can be overstated. But when the Fed's holding things like mortgage-backed securities, right, then that argument doesn't work, right? And I think it's telling that that Governor Waller, more so than any of the other governors, has been very adamant about shrinking the MBS portion of the Fed's balance sheet. So I suspect that, like Waller, Warsh, it doesn't just want to shrink the balance sheet, but also wants to get back to a more normal composition of that balance sheet, where the Fed is just buying treasuries and perhaps even just buying short-term treasuries, so that it's having less of a distortionary effect in financial markets. It's not affecting relative prices as much as it is now. So, certainly we can argue about how many treasuries that the Fed should be, how much in treasuries the Fed should be holding. But it needs to get out of the MBS business, right? It shouldn't be loading up its balance sheet with non-treasury assets.
So, Lydia, do you think shrinking the balance sheet would be a good way to maybe pull some of this excess liquidity or slow nominal GDP spending, or is it more complicated than that?
I think it depends on how you would go about shrinking the balance sheet. If you try to get rid of it all in one fell swoop, sell everything, crash the treasury market, crash the MBS market.
Yeah, that'd be a bad way to do it.
That would probably not be ideal, but I was somewhat disappointed to see them move away from the slow shrinking of the balance sheet through just roll-offs. and then to reintroduce in December the repurchase of especially treasuries. I think the MBS are still rolling off, so they are changing the composition a little bit, moving towards a more treasury, less MBS. So that is a step in the right direction. I think it's important to remember, though, as that process happens, that just means it's the completion. We don't like to use this word anymore, but it's the completion of debt monetization. All that money is now fully paid into the economy, and we've absorbed it in the form of higher prices. So it isn't necessarily a panacea to be just let this stuff roll off, although would be less harsh than liquidating, and the economy does not like to be jerked around. We don't like huge shifts from one thing to another. So in terms of just trying to keep things slow and steady, I would say that would be a preferable process, but a lot of it depends on the overall stance of monetary policy and what the economy needs in terms of liquidity. I do still tend to think that we're still a little bit out over our skis in terms of the amount of money sloshing around, whether that's in the ample reserves and the excess reserves that the banks are holding, or just the amount that's in Wall Street and other accounts. And so having that money on the sidelines when you have a supply shock like we're having with oil prices in the Iran conflict, that pulls that money off of the sidelines, off of those balance sheets, and it has the potential to be incredibly inflationary. And so I think the Fed, they love the precision of their ample reserve environment, because they pick an interest rate and lo and behold, it turns up that way the next day. One of the staff members, I remember mentioning that shortly after 2008 when they got the authority to pay interest on reserves, about how precise and scientific it was, but is one of those things where it can get out of hand very quickly, like we saw in the COVID inflation. And so I'm skeptical that this new framework that the Fed has pressed into since the financial crisis is the best way to continue managing monetary policy. The other part of that, kind of similar to Will's point about the allocation of the Fed's balance sheet, it is a question of credit allocation and where is the Fed tipping the scales throughout the rest of the economy. And it's not just about what's on its balance sheet in terms of the makeup between treasuries and MBS, or during COVID, you had municipal bonds that have we've got great research at AIER from one of our colleagues about how that just encourage municipalities to go into more debt that they still can't pay off, and it just puts their taxpayers in an even more difficult situation. And I say all that to make the point that the issue here is that the Fed has a very large footprint in the overall financial system of our economy, in credit allocation writ large. So it's not, and that's something I think that we need to be more mindful of. Should the Fed really be that involved in the choices between which types of things our economy chooses to put our investable funds, our loanable funds into? And I would prefer to see markets play a larger role in that than they are at present. And that's largely because markets, can allocate resources efficiently to the things that consumers most desire and to the things that are usually most sustainable over the long run. And so as much as the precision is great with a large balance sheet, which is needed in order to have the ample reserves so that they can be so precise with interest rates, I think the longer term consequences are more severe about where is it we're not investing in the economy because of the Fed tipping the scales one way or another. We have this huge AI boom, but this is very much funneled through the financial services sector. Why don't we have booms in other areas of our economy that are maybe less financialized? And I think some of that has to do with the Fed and its outsized role in deciding where credit ends up.
Well, so we'll see if we hear this from Kevin Warsh at some point about reducing the footprint of the Fed. I think that'd be a good slogan. We'll see if he takes that. Reform is tricky. The Federal Reserve is a big system, very institutional, very slow, very risk averse. Talking about mortgage-backed securities, it just reminds me we're almost 20 years out from the 2008 financial crisis. They still hold mortgage-backed securities. It is really hard. It's a slow ship to turn. We'll see what he's able to do, and we'll see what impact that has on the Fed and on monetary policy going forward. Well, Will and Lydia, thank you for joining me for this episode of The Economist Next Door.
My pleasure.
Thanks for having us.
All right.